Nearly $800 billion evaporated from big tech in just one single trading session. Wall Street is freaking out over massive artificial intelligence spending and oil topping $100. But smart investors are actually using this exact pullback as a gold mine opportunity for next week. Here is what is really going on beneath the market surface. Tech giants like Alphabet and Tesla pulled the S&P 500 down over 1%. They showed massive capital spending on AI infrastructure, but shorter-term profit margins took a slight hit. When megacaps drop together, panic spreads fast through retail accounts. What most people do not know is that underneath this high-profile sell-off, defensive sectors are quietly hitting brand new highs. Healthcare surged over 1% while technology was sinking. Money is not leaving the stock market right now. It is simply rotating into safer and cheaper areas. If you are looking at U.S. equities next week, focus on healthcare and industrial stability. Take a close look at UnitedHealth Group or the Healthcare Select Sector SPDR fund, ticker XLV. These assets pay steady dividends and tend to hold up firmly when tech growth gets shaky. Over in Europe and the UK, the market dynamic looks completely different right now. European markets took a tumble alongside the US, with the Stoxx 600 dropping over 1%. However, the European Central Bank is holding rates steady, while economic sentiment index numbers jump to over 23 points. The surprising part comes next when you look at the United Kingdom. UK employment just jumped by 147,000 jobs, smashing expectations. Meanwhile, UK headline inflation cooled down to 2.6%. That gives British consumers real breathing room and spending power. To capture this European resilience, consider looking at the iShares MSCI United Kingdom ETF, ticker EWU. It gives you instant access to high-yield defensive British heavyweights like Shell, Unilever, and HSBC. European energy and consumer staples are trading at massive discounts compared to U.S. tech stocks. By the way, if you want daily stock market breakdowns that cut through all the Wall Street noise, hit that subscribe button right now. Joining the community ensures you never miss our actionable trade setups posted every single day. Now, let us talk about energy and commodities, because oil just broke above $100 a barrel. Energy supply tensions and Middle Eastern shipping disruptions are driving crude prices up sharply. While higher oil hurts typical consumers, it creates a massive cash flow boom for global energy producers. Investors should evaluate adding direct energy exposure to hedge against inflation spikes. Look closely at the Energy Select Sector SPDR fund, ticker XLE, or individual global producers like BP. These companies generate billions in free cash flow when crude stays above $80, let alone $100. Before you skip to the end thinking you need to take massive risks in equities, consider fixed income. Bond yields have shot back up to very attractive levels. The U.S. 10-year Treasury yield just touched 4.7%. That is a 4-year high for risk-free baseline yield. Simple cash preservation strategies are paying out real returns without equity market volatility. Look at short-term U.S. Treasury bills or the iShares 1 to 3-year Treasury bond ETF, ticker SPDR. You can lock in over 4.3% guaranteed yield while waiting out tech volatility. To prepare your portfolio for next week, keep your strategy simple and balanced. Allocate a piece to discounted U.S. healthcare, a piece to high-yield UK equities, a hedge in energy, and a cash baseline in short-term treasuries. Look out for our next video posted daily right here on screen to stay ahead of the markets.